Hello and welcome everyone. Welcome to this Friday webinar. This is Kamal Manocha from PMSAIF World, taking the rhythm of our weekly webinars ahead. As this year 2025 has begun, today we have Mr. Ashish Goel from Investsavvy PMS, a new PMS, which we have been watching very closely, has been doing really well, and that intrigued us to interview Ashish to understand, what's his forte. And what can be other topic than the one that we have thought, that how to navigate in 2025, which looks to be an opportunistic year to wait and kind of do very patient and good investments because markets are resetting for future returns. And that's the topic that we have set for today. Welcome formally to this webinar, Ashish. We had started this rhythm of doing these well-informed, discussions way back before COVID, and this tradition continues because we are in constant learning process. So, I would want you to first address what are your top level thoughts on markets, to begin with. We have been seeing markets are in a corrective mode and all of us were waiting for this correction to come. But whenever it comes, it's always painful. But at the same time, this time correction is like looking to be different because though markets have corrected, but valuations still seem high. There has been a stock level correction, but index level correction is still kind of not visible. What are your top level thoughts, at the current juncture to begin with?
So while I'll go through, I have some thoughts on how people should take their way through 2025. At the top level, I would say equities really are resetting. And this year is going to be quite an interesting year because as you rightly pointed out, there has been a correction in the indices, but some of the valuations are still high. And unlike earlier years where a lot of COVID investors, and that's a term I use for people who've basically started investing after COVID because you were in the house, you had tons of time, and you started investing and you have basically seen a massive bull rally, and that's all people have seen. So now is the time where not everything will go up. So earlier, if you picked up 5 stocks, possibly 4 went up. This year, it is going to be a lot more into picking the right stocks because overall the index may not give exceptional returns. The other thing which will happen is that with so many uncertainties lined up, you could well have to continually monitor and see how the situation changes. So unlike earlier where you could basically take a call on the market and sit on it and just wait, now you will also have to be a little more careful in seeing trends with changes in policies that could come in. The reason being that, we know that on 20th, Trump will be taking over as the president. And he's been having a lot of thoughts on how he wants to take America forward. I'm not exactly sure as to how much of it is posturing and what amount of it can actually be easily implemented. Because even if you look through his narrative, which he started out with, you can see significant softening coming in post-elections. So there are things like he said, I will stop all environmental EV-related, environment-related investments and projects. Now it's changed to, maybe new projects will be looked at, but the older projects will be continued. New projects may not. So on various other factors, his stances have been seen as moderating. Now, clearly, as is very obvious, a lot of, and that's politics across the globe for you. When you are in the election race, you are like, oh, I need to get in. So it's like the classic bus dilemma. When the bus is, when you want to get into the bus, you say, oh, there is space, kindly squeeze in and let me in. once you're in, then you say, oh, why are people coming in? It's so crowded. How do I stand? So similarly, politicians also say one thing before they are coming into power, and they may do slightly different. I think he's a very smart businessman and he's a deal maker. So a lot of it could actually be posturing to get better deals for the US. But coming back to equities, it will truly be an year for resetting of equities, because not only in value terms, I think quite a bit of resetting has happened, but not only in value terms, also in terms of sectors which would perform, those could change. And there are various factors. I'll go through some of these as we talk, but things are changing. So in a changing environment, you need to continually relook at your portfolio, relook at your thinking, reevaluate, because there's a very classic error which is made, and it may not be directly related to markets, but when if you've noticed at a zoo, an elephant is tied with a simple rope and a small khooty in the ground. If the elephant actually wanted to move, that thing in the ground has literally no resistance. But the elephant is tied and it stays. Reason being, when it's a child, they tie him to that khooty, and at that time he is very young, he can't pull it. So he tries his mightiest for the first few years and he cannot get out. Then when he can actually get out, he never tries. So similarly, a lot of times investors invest, they do a lot of analysis possibly, or look into the stock when they are buying it, and then they forget about it. And situations change, parameters change, performance changes, management changes. They are still stuck. Oh, that's a great stock. It's given me returns. I will always keep it with me. Now, while coffee can investing and other bits have value in it, and I myself believe in buying and keeping the stock for a good period of time. But what is critical is to continually monitor it. Just because somebody is not selling it doesn't mean that, oh, I am not going to sell it, so I will not even reevaluate it. You have to continually look at it, how the environment is changing. And because we are going to see a lot of global changes coming in, policies, the way businesses operate, even supply chains will change, because with Trump coming in, possibly a lot of wars which have been going on may kind of get sorted, as he's been, he basically said, I will stop the war in one day. He did send a notice to Putin that, stop it. And he said, sorry. So it hasn't stopped. But my guess is that definitely a lot of these will get sorted, because without backing from the US, some of these things will be difficult to continue with. So I think investors definitely need to be mindful, but they also need to remember that, like FOMO is not good, neither is FOLI. FOLI is basically fear of losing everything. So when markets are going up, everyone's having FOMO. And when markets start going down, first 5% it's a dip, opportunity to buy, 15% it's FOLI. Sell everything, world is going to an end. So I think things are never really as good as people make out to be when there is a total bull market happening, and things are never as bad as people make it out to have, be when things are, market is going down.
No, Ashish, well put. You are a learned fund manager. I can absolutely see that, and your 25 years of experience with very credible, I would say, qualification background and stars behind that are all visible. And yes, the recent performance of Investsavvy is also an evidence to this. So as you mentioned that things are changing, and we all know that ultimately price is slave of earnings. Where are earnings moving? Have you done some analysis sector wise, business wise? It's this resetting process has already started. If we talk about, say, Indian economy, last 2 quarter results and the third quarter results which are coming, And at the same time, we know two heavyweight sectors, which is like financial services and IT, have been languishing in terms of valuations. Probably they are the most attractive ones. But this resetting process, will that bring them up, or something else will come up? How do you want to kind of I would say solve this puzzle of what lies ahead?
See, I think both while IT sector and the results in IT and banking which have come out at first have not been that great, but I would like to put one very important thing which people should keep in mind when they are investing, and that is that it's not a one quarter game. When you are evaluating a company, the basic way to go about it is we look at it in the long run. And there, if you feel that the big picture, the long term is great, sometimes the short term dips are really useful in getting good valuations. So what happens is there is a recency bias. People look at what is happening right then, and so if one quarter results are bad and the commentary is not that great, people sometimes just erase short-lived memory. They'll just forget everything of earlier and start having the bearish kind of narrative going on. So the way we look at companies is slightly different. We actually believe in a bottom-up approach, and therein we concentrate a lot more on the stocks, the individual stocks, rather than the whole sector. Because as I said earlier as well, if we want to take a call on the entire sector, yes, I think IT has been languishing. I think there are good days ahead because there are quite a few factors which are looking up for the industry. If you look at dollar appreciation, frankly, IT companies are mostly like a dollar, should actually have a dollar balance sheet because their revenues are primarily related to dollar rates and their expenses are actually in INR. Some of them are also in dollars. But so therefore, if you see dollar appreciation, that's great for the IT industry. So while for discussion purposes, they always talk of same dollar and stuff, we cannot forget that in an environment where Trump is coming in and the dollar has been appreciating dramatically, and it is not just us, it's across all currencies. So there, that would be a factor which is resetting. See, that is exactly the point. I personally didn't think, actually, I don't want to go into individual companies, but the results which came out, I personally didn't think that they were that bad, that it should have got bashed 6% in the ADR and all that. But rather than go into the individual stock specific bit, I think maybe if you want, we could go through a little bit on the macroeconomic landscape right now and common mistakes which people should avoid in the current scenario.
Absolutely, let's do that.
Okay, so I have a small presentation because I find that sometimes it just helps focus. Let me just okay, is this clearly visible?
Yes, this is visible. You need to switch to the single slide mode. That's it. Slideshow mode.
I have actually shifted to. Okay, just a sec. Hold on. Yeah, I have two screens, so maybe because of that. Is this visible? No, sorry. Just a sec. Is this better?
Yeah, this is visible.
Okay. So Actually, just a quick brief about myself while you've introduced myself. I have done a master's in computational finance from Carnegie Mellon. I was a rank holder at both Carnegie Mellon and IIM Calcutta. I was BTech from IIT Kanpur. I've worked across the globe in Singapore, UK, USA, and various investment banks and hedge funds. I was an MD at Stanchart as well. And as you rightly said, our fund has been in the top 5 funds both in 23 and 24. And it's outperformed the market. Now, where I was coming in was when we look at the macroeconomic landscape, one interesting point is that, depending on how you want to paint the picture, you can have a bullish narrative or a bearish narrative. And what is interesting is when things are bullish, people are mostly concentrating on the bullish part. And when they are bearish, they're mostly concentrating on the bearish part. The reality is it's always in the middle. So like in US markets, let's look at the week which went. On Friday, jobs data came out in the US. You had very strong jobless claims. Unemployment was down. So everyone thought, oh, now since jobs are doing so well, economy is doing well, there will be no rate cut, and market tanked. So as a result, since this happened after market hours for India, Monday, we all know, most people were down 4% odd. Then later in the week, on Wednesday, we saw that you had inflation data coming in. And guess what? Inflation was also lower than expected. Now people are like, oh, inflation is lower. It's following the trajectory, rate cuts probability. So rate cut probability, which had gone to 20% by March for a rate cut by March, jumped to almost 30%. And we saw a pullback in the markets. So if you're talking about bullish, you have Trump coming in. On the bearish side, which nobody talks about because it's far in the future. And as I said, people concentrate a lot more on the near end than far end. US debt is definitely an issue. If tomorrow things were to go wrong in the US, everyone will start doubting, oh, US debt has grown so much, the economy, will it sustain, fearmonger, end of the world and stuff. Now, if we look at Trump policies, there was a study by the Economists International Intelligence Unit, which actually said that, they rated all the countries from -3 to +2. And India did factor in as one of the most benefited at +2. So the impact was limited and positive for India, while Mexico and Russia were at -3 and -2 because there were issues on sanctions, etc., which would come up. If we look at China, the bearish narrative which is going on currently is that the real estate sector is still weak. Oil imports have declined, and I think this is the first time in 20 years their imports have declined. Even through COVID, they had increasing imports. Reason is that EV adoption is picking up, and economy has been slow. Corporate earnings have degrown for the last 3 years. But if you want to look at the positives, and as we saw in the second half of last year, suddenly there was a huge jump in China because people were saying, oh, there'll be a big government stimulus and things will look up. So there was a big jump in the markets at that point of time. Everyone started rushing to China, and then again they started moving out. Real estate sector is showing signs of initial recovery after a very long time in China, but it's nascent. So there is a green shoots coming there as well. If we look at oil, while right now oil has gone up quite a bit, so which is bearish for all economies, especially India, because we are talking about stronger sanctions on Iran and Russia, etc. But if we look at the other side, Trump was against continued war, and he has already said that he will increase oil production in the US. OPEC and EIS say demand is reducing, China EV leading to reduced oil consumption. So in the medium to long term, it looks like oil should go down. So that would be positive. Now let's come to the Indian market. Now, right now, the narrative going around is GDP estimates have been reduced. So GDP growth is not there, consumption is not picking up, corporate earnings are weak, INR is depreciating, valuations are stretched, all valid points. But if we start looking at a bullish narrative, one thing we should not forget is government capex was very low in the first half. It was 37.5% as against 49% of the capex budgeted in 23 because of elections and then a prolonged monsoon. So as against 49% having been spent in 2023 H1, in 24 H1, we only spent 37.5. So that bit will catch up. So you will see that coming back into the economy. Inflation numbers have come in a little lower. Industrial production numbers are looking up. And while the INR depreciation is a fact, there is, I can show you, there's a chart which shows that it's really, is it rupee depreciating or is it dollar appreciating? Now, if you look at the last 3-4 months, we are looking at a lot of other currencies who have actually depreciated a lot more than rupee. So it's not really that rupee alone is depreciating. So I'm not saying it's not good or there is no issue, but what I'm saying is it's not that we are the only ones. It's possibly also that dollar has appreciated against most currencies. And in all these bearish short-term narratives, we forget that India is still one of the fastest growing economies. China +1 is still on. Demographics wise, there's a young growing population with a large educated pool. In fact, there was a study by Goldman Sachs which basically said that between 24 to 27, in 3 years, the number of people who have a per capita income of more than $10,000 will go from about 60 million to 100 million. Now, these additional 40 million people will be the guys who will really drive consumption. So we cannot forget that fact. There is definitely that consumption story which we are talking about. Government is stable. Equity as a percentage of household wealth is still very low. So it's moved up from 2-3% to about 6%, but globally it's about 15%. So another study which came out was that this is a bit dated, but this holds that
if you're trying to show any other slide, we can only see the first slide, Ashish.
Oh, sorry.
Yeah.
Just a sec. I think. Can you see this?
Yes, now you can see the changes in the slides. You can maybe show the slide again.
I'll do it.
Dollar versus.
So I'll show you this slide. So I've spoken about some of these things. Just a sec. And so what we were saying was the long-term story holds. If you look at the slide on rupee versus global currencies, you can see that, the pound, GBP, euro, dollar, Singapore dollar, Canadian dollar have all depreciated quite a bit since September 26th to January 15th. So rupee has actually fallen, but it's not just rupee. A lot of other currencies have fallen too. Also, there was a study done. This is KR Choksey. This was done some time back. That when economies grow from a 2 trillion economy to a 5 trillion economy, there have been huge bull runs in the stock market. So all three countries which went from 2 to 5 saw massive bull runs during the period. So China took 5 years. It went up 4 times. US took 11 years. That bull run continued for another 22 years after that. It went up 17 times. Japan went up 19 times. So what we are saying is India, for that matter, in fact, the IRRs in that zone were in the range of 30 to 40% on stock market. Whereas in India, we started in 2015 and it's been closer to 11-12%. So, we still have, if this plays out, that could also be another factor. But let's now also look at some of the common errors which people make. and you have to avoid these this year. So we
Ashish,
have
you
to
should try to maybe maximize the window. On the top right, maybe that the maximize button you can try and press if this works.
Is this visible?
Yeah, it's visible now. Better.
Yeah. So if we talk about emotional investing, you obviously have FOMO when bull markets are there, and FOLI when fear is there. Now, if you look at markets, let me just make this a little bit. So if we look at all markets, all Indian indices, most of the major indices are down between 12 to 25% or 20%. Now, when market falls 5%, people think it's you buy on dips. But when it's fallen 15 to 20%, why is everyone ready to exit or thinking of exiting or stopping loss? Or, people say, oh, let me protect my profit. Now, this is where people make the biggest errors. So you have to be patient. One other bit which actually drives FOLI is investing on tips. If you've done research, if you've followed the company's performance, and you know that markets, the nature of the beast is that markets will go down and they will go up. While there is a very popular celebrity investor, teacher who says that, there are two things, whether it's an आदमी हो या stock market, end में ऊपर ही जाना है. So I find it funny, but in a way, I think for the current situation that Indian markets are in, I think we are in a long-term bull market. So a short-term correction, and it could be 10, 20, maybe a little more. See, currently, I don't see any major reasons for a much deeper correction. Yes, we could have some policies coming in from Trump, which could lead to volatility. Budget, I think a lot of what was to be done is done. So this year, I am not really expecting too much of turmoil because of that. But broadly, I think things are on track. And I think the fact that government spending will come in should lead to a positive. But what I'm saying is there should not be sudden exits and sudden entries just because you are seeing a little loss on your portfolio. Investing on tips is something you should avoid, because when you don't know why you invested and only somebody told you and he also doesn't know the reason why he's invested, then you basically sell everything. You'll sell the trash with the good stocks. And remember that if you have a stock at 100 and you buy it, you can lose maximum 100 rupees. But if you sell it, you could potentially have lost a lakh also, because there are shares which have gone from 100 to 1 lakh over time. So you need to remember that. And recency bias is something which I think retail investors are most hit with. They just do emotional investing. And when everyone starts saying, oh, this is wrong, that is wrong, they just think everything's wrong. It's never that. You need to have a investment plan that with clear goals. Please do not do entertainment trading. This has become the latest fad. Everyone, whenever they open the app, they have to do some trade. There's no reason, but they'll just do some trade. So like there is somebody I know, I ask him, whenever he opens, he'll buy or sell something. Reason? No reason. And there is no research, nothing. So at that time, whatever he will see, he will buy. So avoid. And market timing, nobody can do. The best of investors, the most revered of investors, nobody can time the market. So avoid that. You have to avoid investor overconfidence. A lot of people who've invested and seen only the bull run should remember that there are reasons why stop losses are there. There are reasons for managing risk. Don't forget that. Avoid leverage. Totally, this year is not the year for leverage. Also, concentrated portfolios, while they might have done very well earlier, this year, you should look at a diversified portfolio and don't ignore costs and taxes. I will come to another example later, but don't ignore that. So I think it's a stock picker's market. You should do research before you get into any stock, or let a professional do the same. So if we look at some of the things you can follow, you should always look at stocks which have a compelling story or a moat and which are potential multi-baggers. Do a relative valuation so that you get a handle on it. Then you can look at valuing the stock intrinsically, looking at cash flows and an in-depth analysis. Talk to management or hear management speak, and MDAs, etc., conference calls, etc., to get a sense of how the management is, what are their plans, are they competent, are they honest. A lot of people talk about corporate governance. You have to definitely look at both the competence of the management and the honesty of the management. Honesty is definitely required. Without that, if you don't have comfort on the honesty fact, then don't go any further. If you don't see relative valuation is good, don't go further. But if you see these things are right, you should still try to figure out whether the management understands the business. Are they having infights? Are they harmonious? And finally, all that, follow the cash, look at a margin of safety, and also look at overvalued stocks for exits. So you should not only look at what you're buying, you should also look at what are the stocks you need to sell. Technical analysis can help in identifying entry and exit points, but when it is backed by fundamental research, then it helps you have that confidence. I'll give you an example. Like if you look at Monday, I got multiple reports that Nifty could be going down for a deep correction, etc. Then on Wednesday, market rebounded. On Thursday, I was getting reports that, now Nifty is going to go up by 2,000 points. So the technical analysis can change very quickly. So, but if you look at fundamental analysis for a company, you can always look at, have the confidence that if things have gone down, they will bounce back. And, always remember, like there's always bad news and good news. In any market, there are stocks which are going down and going up. In a bull market, there'll be more stocks which are going up and less stocks which are going down. In a bear market also, you'll still have stocks which have done very well. So if you choose the stocks right, you will likely, still not do as badly. Now, obviously, nobody has a wishing wand or a magic wand where they can just get that, these are the 10 stocks which will do well this year. But that's why if you have a diversified portfolio and you put in effort in looking through all the stocks and tracking them and monitoring them, you are more likely to end up with a few more winners than you will be having losers. So if the market is falling, obviously protecting capital is paramount. So you may not see great returns, but when the market bounces back, the good stocks really outperform the bad ones. So you should do a lot more analysis when looking at stocks. This is our portfolio performance. We've given 50% in 1 year, 2-year return is 64%. We were generally pretty good amongst the top 5 last year and this year. And Kamal ji has been very kind. We've seen us being reported there in their top charts as well. The performance when we started, we are literally at 3 times where we started, where the index is about 1.5, 130 to 170. So 70% absolute versus 200% absolute. So returns have been decent. And in terms of learnings, again, I'm just saying these 2 things or these 3 things you should always remember. That equity markets always have stocks which will outperform and underperform. Perfect timing is not possible for any investor. So the key is to stay invested and don't try to jump in with 10x the money when market's gone up. please have a investment plan which is spread out, because otherwise I know of a person whom I told him, he was asking for a stock. I told him something. He bought 10, 10, 10 at lower levels, and then he went ahead and invested 100. And then when the market went down 10%, he sold everything because he thought, oh, I'm losing my profit. Let me get out at zero. And then that stock again went up, to be double, and he lost money. So invest for the long haul. Don't let FOMO and folly hit you. Now, there's one question I have, and maybe, I don't know if you would like to just take a quick shot at this. You have 250 shares of a company, and each share is for 1 lakh rupees on January 1st. You get a boon that you will make 5,000 rupees every day if you trade one share every day. So at the end of the year, you are also told that the stock will be double of what it is today. So should you trade a share every day and make 5,000 rupees every day? This is intraday. You'll buy and sell the same day. So should you do that or should you not do that? Any responses on the chat, or anybody wanting to take a shot at it? I can't see anybody. So, okay. Anyway, so the thing is, while it looks, so I had asked this to some people in my team as well, and it seemed to make sense to make 5,000 bucks every day. And this is something which some people I know do, right? But the reality is, if you did take that 5,000 every day, at the end of the year, you'll pay 20% short-term gains tax, and you'll also pay your transaction costs. So you will end up paying 7.5% more tax, and you'll also have transaction costs. Now, if you look at that, then on a 1 lakh rupee share, you will end up paying 7,500 for per share on tax and transaction cost. You have 250 shares. So in the full year, you would have sold and bought your entire portfolio. So effectively, while it looks that, oh, I'll make 5,000 a day and I'm making 5% in the day, you can't forget tax and costs. So that is a very important factor. I think I'll give it a brief pause here so that people can think about it. And Kamal, over to you.
Sure, Ashish, you can maybe stop the screen share. I think this was very insightful and quite intuitive conversation, and concluding question gave a good piece of food for thought for investors to be acting like investors and not like traders. 2025 requires all these reminders for sure. Even I would say well experienced investors fall prey to such short term trading gains. And it definitely did sound that yes, 5,000 rupee per day again over 365 days will obviously be far bigger than doubling your share price. But
see, you will double your price anyway. So you every day you're buying and selling. It's not that you will not make that 1 lakh rupees at the end of the year. The thing is, you pay extra tax. So on the 1 lakh you will make, you'll still pay 7,500 extra, because instead of paying 15,000 per share, you'll pay 12,500 per share. You'll pay 20,000 per share. So that's why.
Right. You had also mentioned in the beginning that now, as the year is resetting, there could be a comeback of, old, I would say, quality stocks. You mentioned consistent compounders. What are your thoughts? Will that comeback happen, or it's like the overall economy has moved ahead very differently, and now some of those large cap stocks are like going to be only slow, growing stocks from here onwards.
See, large cap stocks by default are slow moving. If you look at Asian Paints, actually I shouldn't be taking names, and a disclaimer, whatever we discuss, we may or may not have any shares that we've bought. This is purely for educational discussion. There is no investment advice being given here. So kindly do your due diligence. But let's say if a stock is having 60% or 55% of market share, and if the market is growing at 5%, then frankly, there is not space for you to grow at more than 5-6% by grabbing market share. You are actually restricted in your growth because of your sheer size. Whereas if somebody has 5% market share or 2% market share or 8% market share, they're still credible, they're still decent, but they have scope to grow. And what also happens is that larger stocks are researched by 50,000 people. Like you'll have every research house coming out with reports on the top stocks. They'll be meeting the management. They'll be going to the retail shops. There'll be people whose full-time job is to follow 5 top stocks, right? So they'll be hired and very qualified, informed research analysts who just do this as a daytime job, morning to evening. There, for you to find an anomaly or a misprice is much, much more unlikely than if you go down to, say, a small cap or a slightly larger mid cap border kind of stock, which is not tracked that heavily by everyone on the street. Because then what happens is you might have a scenario where they have a great order book, they have a great growth planned up, they are turning around, things have changed, but people just haven't looked at them. So a lot of times what we've seen is, and some of our biggest, for me personally, over the 25 years of investing, some of the biggest winners have been cases where there was a turnaround and small company, nobody was actually looking at it, and or very few people were looking at it, and things changed for the company and people didn't realize because they were not tracking, and you saw the biggest bull runs on those companies. So I would say your larger stocks will give you more defensive returns. Yes, from a pure valuation perspective, they are possibly safer bets, because what we have seen is that your larger stocks which haven't gone up that much have also corrected 15%. So the funny thing is that while small cap has gone up a lot more than large cap, on the correction time, both have corrected more or less the same. So the reason also is, I think, and that is where I have a small point or a noting, that all the FIIs only own large caps. So most FIIs have just large cap stocks. And guess who's been selling in this market? So if they are selling and they just own large caps, they will end up selling large caps. So because of that, there is a huge pressure which has been there on large caps. Now, I think as I said on resetting, if we do see returns, corporate earnings picking up for the large caps and FIIs turning, because FIIs have been selling, I don't think they want to crash the market because they're still deeply invested in the market. So if you see, they've been doing a moderate, they moderate their selling. They don't want to crap the market out. But if you start seeing FIIs turning around, and you start, which could be led by policy changes or by corporate earnings, both, multitude of factors. So if you see that happening, that could actually be a great time to switch to large caps, because that is a sector which has not done so well. But then please understand, when market does well, at that time you do see more FOMO, and retail investors are typically much more into buying, mid cap and small cap, so returns could be higher there. But large caps will, traditional wisdom says, correct less, they'll be more stable. Personally, I feel if you are putting in a lot of effort to research, then research, if you're doing it yourself, then do it for a smaller fund, for a smaller company. If you want to go by research reports, then definitely large caps are easier to track. Also, volatility in large caps would be less. So if you don't have this, see, one very important part of investing is that you need to have the risk appetite. At Diwali time, a lot of you would have played Teen Patti, or if you go and play poker. One fact which all of you, if you played, would realize is, if you are on a table where the odds or the bets are much higher than your comfort level, you would invariably end up losing. So similarly, if you get in to a risk sector or a segment where you cannot stomach the volatility, you can't take the daily return movements, then don't get into that sector. Large caps are definitely much more stable. So, Kamal, that's it. As far as earnings go, also one other thing you need to realize, while price earning for a large cap is definitely much lower, and it is much lower than, say, small caps and mid caps, the other fact is that the growth also is much higher for small caps and mid caps. So if you go by the traditional DCF or a discounted cash flow of a firm, sometimes people can look at price to earning upon growth, which is basically also adjust for growth. Then it gives you a better picture than price to earning itself. So that is it. Having said that, large caps are definitely more stable. They definitely have better corporate governance. They are more followed. There's more information on them. So risk of frauds or something like people running away, etc., is definitely much lower. So that way, I think it's a safer bet. But then over time, if you are looking at a 10-year horizon, it is more likely that you will find a higher return on slightly smaller companies than very large companies. But that's my thought. There are people who make a lot of money on large caps as well. So, please suit yourself.
Sure. So now if we spend maybe, last 10 minutes discussing about Investsavvy, what's your philosophy like, and how is it that you have been able to generate this massive alpha, and what should be expected way forward, and what are the kind of, I would say, underlying drivers of, stock picking that you follow in your PMS?
So see, there are 3-4 things. So one is, if you're in it for the long run and you research a company and you put in a lot of effort, 2-3 things you should always remember. We typically like lower debt, because if you've evaluated the company, it will be there for 10 years, etc. Then eventually, if your hypothesis is going to be right, the bigger risk you run is that in between the company goes under because there's a down cycle. So that's why debt is something which you need to look at. The company should be at manageable levels of debt. And in fact, leverage is something both for personal investing and the company investing in which you invest, I think has to be really looked into. We think you should always invest with a margin of safety, because wherever so if you invest in values driven stocks and you do an analysis, it is easier for you to look at the noise. So sometimes there's a policy change or there'll be something and the stock could have fallen 40%. Now, if it's only based on a tip or something, you will not be able to see that whether the change is actually something which should lead to that much of a fall or not. But if you've done value investing, there is some bit of comfort. Like, I'll give you an example as a layman. If you buy a house where it is 1 lakh rupee a square foot, we believe in Delhi, and in fact, Delhi also off late, they're like huge cost houses. Now, if the house is taking 5,000 rupees per square foot to construct, and the price is 1 lakh, then there is, even if you take some land value, etc., it can fall 30% and you'll still say, maybe this is the right price, or it could be lower. But if the house is, if you buy something at 6,000, then after 20%, the cost of construction itself is 5,000. So then that, it can't really, if it goes to 3,000, then that it's a good idea to buy this because it makes sense. So value investing, sometimes, especially in a turbulent time, is easier. You should always also keep your eyes out on tactical investing. So in your portfolio, you should have, so like we have one part which is into tactical, momentum-based, and current change-based dynamic part. And there is one which is a long-term invested part of the portfolio. Now, I'll give you an example of tactical. There was a company which had issued which was merging with another company. The swap ratio was given. And what we had one of the companies in our portfolio, and we knew that in like about a year's time, both of them will become the same. And we were bullish on the company. So what happened when we would see that there was a gap of more than 10% in the swap price, we would swap from one to the other. And then we would swap back. So as a result of that, the underlying stock went up 100% because we had actually done our research and we were very bullish on it. And things played out well for the company. But at the same time, we made an additional decent bit of return because we didn't do 1%, but we swapped a large part from one stock to the other and then swapped it back. So that was tactical. Then there was another company which we invested in. And then you had, this was early days and 2022. And there was export duty, imposed on steel and iron products by the government. The stock fell 40% in 2 days. And it was already very cheaply valued when we had bought it. It fell 40%. We looked at the scenario, we evaluated, we spoke to the company. We realized that sales are not coming down. The price will be adjusted. They were actually exporting 70% of their production. So the question was, people thought they will not be able to sell it. But we realized, and we saw EV EBITDA, we looked at various factors, everything, and there was no logic to it. So once the price kind of stabilized, stopped falling, we doubled our position. The stock went 4 times from there. So not only did we make money on our original investment, we also made money on much more money on the investment we did at a lower level. So I think these bits are important. Also, we typically try to have, we look at growth at a reasonable value. And there, sometimes what people miss out is EBITDA growth is just as critical, in fact, more so than the top line growth sometimes. So to give you an example, in 2022, you had this whole war happening. Crude prices went up. Everything was becoming very expensive. Tire sector was badly hit because the costs had gone up dramatically. So they revised the prices, but the stocks were badly beaten down. What we realized was that after some time, rubber prices fell sharply, but the prices didn't go up of the stocks. So what we realized when we did an analysis was that their EBITDA would jump by anywhere between 5 to 8%. We know they would pass back 1 or 2% to the customers, but that would still mean a 5 to 6% jump in EBITDA, which we realized. So we picked up a company which had current EBITDA at 5%, and we realized that their EBITDA would double or more than double, but their profit would go 3 to 4 times. But basically, since they have a 2-3 month inventory, the results will show it only after 2 quarters. We held on to it for 6-7 months. Then the quarterly results started showing the benefit. We overall held the stock for about 1 year and a few months, 2-3 months, and the stock went 3 times. So that was clearly that, because what happens, your revenue goes up 10%. If everything has gone up 10%, your profit will go up by say 10, 11, 12%. But if your EBITDA jumps 5%, if it was 5% earlier and now it's gone to 10, numbers go up more than 2 times. So it is very critical to keep looking at the whole thing. In fact, when you do a DCF, you realize revenue is important, EBITDA is important, costs are important, and you start seeing how things are impacting each other. So try and understand what's going on. Also, we like to put a part of our portfolio into companies which are not really, really small, but companies which are showing very strong growth prospects and have not, whose valuations haven't gone through the roof already. So there we've seen a lot of benefit because like there are companies which have, we met a company last year, they had an order book, which meant that their profits would go 3 times in 2 years or 4 times in 2 years, because they had a huge order book and their bottom line, their top line was going up 3 to 4 times. So profit would go up much more than that. And when we met them, we were surprised that, the stock hasn't moved. So we bought that company, and the company then later on went on to grow 3-4 times in 1 year itself. So, those are things where you really make an alpha. And I think that's how you need to be nimble. You need to keep watching. And you need to look at long-term stories. I think that's about it.
Sure, Ashish. I think, the way you have explained your philosophy, kind of presents that, yes, it's like absolutely a stock picking style based on in-depth research. And that is the reason why, your PMS has been generating a lot of alpha. And I wish you good luck in years to come.
Thank you. Thanks a lot.
We at PMSAIF World, always like to work with such stock picking boutique fund managers who are focused on alpha and doing extra effort. There is no substitute to hard work, and you have decades of experience behind that, and that's absolutely kind of credible. 2025 is a year definitely of resetting, and that's where we kind of are glad that you gave us time and we were able to do this conversation with you. Thank you everyone for joining. If you have any more questions and you want to do any conversations which are your concerning points or any evaluation or review of your current portfolio you want, you can book your appointments with us at PMSAIF World. We do very sincere and passionate work from investors' point of view, and we're doing it really, I would say, quality, investment conversation with all our clients, manage more than 1,500 crores of assets, and we have built that, case by case, client by client, and we do that, with a very sincere approach. Thank you once again and have a nice weekend.
Thank you, everyone. Happy investing, and wish you all a great year ahead, because we are all into investing, and if everyone makes money, that's great.
Absolutely. Thanks for good wishes.
Thank you.
Okay.
Thank you.